Hello students, welcome to week 4 of the Accounting Principles course. I hope and pray all is going well for you this week. As always, be sure to check out the devotional for this week and be sure to read the assigned reading from the course text. All right, let's take a look at week 4's learning objectives. This week we're learning how to define current liabilities and identifying the concepts that underlie those the concept of current liabilities. We're also looking at how to identify, compute, and record what we would term estimated current liabilities. And we're also learning how to identify the valuation approaches to fair value accounting. And we're studying the ratio analysis of some components to manage the impact of current liabilities and their impact on liquidity. And liquidity, again, is the amount of cash that you have on hand, to pay bills and that sort of thing. All right, if you recall from last week, we looked at long-term assets on the balance sheet, and this week we're looking at current liabilities on the balance sheet. So last week was long-term assets. This week's current liabilities, both discussions about the balance sheet. So current liabilities are debts and obligations that a company expects to satisfy within a year or within its normal operating cycle. Now, as a decision maker, it's important that you understand how the concept of current liabilities works. Let's talk about one particular type of current liability known as estimated liabilities. Estimated liabilities are definite debts or obligations whose exact dollar amount maybe can't be known until a later date. Some examples might be income taxes payable. Your income taxes may fluctuate and do fluctuate with your sales. So you estimate them up front, but you're not sure what they're going to be at the end when sometimes you have to pay them. Property taxes, the same way. Product warranties that are out there. We often don't know these amounts until they actually happen or until we get the final bill. So they are estimated. Another liability that businesses have to keep track of are vacation pay. You may not know this, but your employer keeps track of a liability, hopefully they do, called vacation pay. It's another type of estimated liability. And now in most companies, employees accrue paid vacation as they work, like your PTO. As you work along, you accrue PTO time where your employer is accruing the dollar amount that goes with that. So vacation pay is not always known because a business is not always sure if all the employees are going to take some or all of their vacation during a particular accounting period. So most businesses will estimate the dollar value of that vacation time that's due to their employees. Let's switch topics for a moment and talk about the valuation of an asset or a liability. Fair value is the price for which an asset or a liability could be sold, or what it could be worth. And there are three approaches to measurement of the fair value of assets. Or fair value of liabilities as well. One's the market approach. So what can you get for the asset on the open market, for example? And I mentioned the example before about the old historical car and what that might be worth. So the other approach is the income or the cash flow approach and the cost approach. Be sure to read about these in the course text to learn more about them. Let's pause for a moment and talk about the time value of money and the future value of money. As you probably already figured out in life, the value of a dollar today uh, is not the same as the value of a dollar 20 years ago. Yes, it still says $1 on it, but what you can buy with it today is different than what you could buy with that 20 years ago. And it won't be the same value, that same dollar won't hold the same value 20 years from now. That's because the inflationary and deflationary processes of our economy create effects on the value of that dollar. In fact, I would say around the world, it creates the effects on our dollar. Things going on around the globe. So a dollar today buys more than it did, for example, in the 1970s when inflation was very high. So we have to talk about the time value of money. The time value of money refers to the cost or the benefits of holding or not holding money over time. Interest has a major impact on the value of money, and so interest is the cost of using money for a specific period. And the amount of principal plus interest after one or more periods is known as the future value. So be sure to read about the time value of money and the future value money in your course text. When we talk about current liabilities, we're going to switch back to current liabilities for a moment and have that discussion. We have to remember why current liabilities exist. The primary reason for a company that a company incurs current liabilities is to meet its needs for cash during the operating cycle. So, if a business doesn't manage its cash flow as it pertains to its current liabilities, like accounts receivable, it could run out of cash. So, be sure you know how to calculate the working capital measure and the current ratio. Both of these measurements are taken from the balance sheet and they give a health indicator of the sorts, a health indicator of sorts for how you're doing on cash flow. All right, a final key measurement of a company's health is the payables turnover. So in short, it's the number of times that the company pays off its suppliers in the accounts payable system. So where accounts receivable is where your business is receiving money from its customers. Accounts payable is where you're paying out money that you owe to your suppliers. So managing the number of times is a topic of discussion in the course text, that rate of payables. Sometimes you'll want to save your cash and extend payments out to your suppliers, and sometimes you'll want to pay off your suppliers right away. In either event, your cash flow is impacted. So just understand that and read some about that in the course text. All right, that's it for now. Remember to get your discussion questions turned in and your quizzes and assignments in on time. And remember, God is on his throne. He's always been there. He's always going to be there for you. Have a great day.